So this is Ron William, technical strategist here at MIG Bank based in Switzerland within the research team. And this is part 2 of dollar-yen long-term structural change. For any contact details for myself, the email address is r.william@migbank.com. You can also reach us on social media sites such as Facebook, Twitter, which is rwilliam77, and of course you can also look me up on LinkedIn, just under my name. I also update the blog options on forexstreet.net, which is part of the FX Street package. And so these are the contact details should you wish to follow up with any questions or just stay in touch. I'm more than happy to do that in the future. Okay, so it's good to be back. I was here just yesterday, and as per usual, I had a lot of good and comprehensive observations and ideas to run through. So we agreed, and FX Street were very kind to invite me on for a second time around for a part 2 on what is proving to be a very, very, very important market at the moment, dollar-yen, especially after, as we all know, the recent intervention from the Ministry of Finance in Japan. Now, I'm going to quickly go over this section for those of you who may be new here. I've been in the market for 10 years, working with various consultancies and also with the global media firm Bloomberg, visiting various institutions in the market, banks, hedge funds, and so on, helping with trading strategies, but also developing new ways of analyzing and trading the markets. There's 3 areas that I focus on. Number 1, market cycles. So that's just focusing on time, historical cycles, and also economic cycles. So the correlations and relationships between different markets. Second, chart patterns, specifically Japanese candlestick patterns, which are very good for timing reversals in the market. You can get signals in just a few sessions, and that allows you to maybe have an edge over various other traders in the market. And then lastly, advanced indicators, one of which are called DeMark indicators, developed by a very well-known investor and trader called Tom DeMark. His indicators are renowned for picking out reversal points in the market, and they're seen as one of the best market timing indicators to use, especially in volatile markets. I spent some time with Tom DeMark in my previous employment at Bloomberg, developing the product there, and so I got to kind of learn his methodology as best as possible, and it's definitely something I use in my day-to-day trading analysis now. So these are 3 areas: market cycles, Japanese candlestick patterns, and DeMark indicators. These are the 3 central areas that I focus on the most, in addition to many other areas. Now I'm going to ask this quick question here today because I'm sure we've got a mixed crowd. Just a quick question. If you can tell me 2 things. 1, where in the world are you attending this webinar from, and were you here at yesterday's webinar? So if you could just tell me which country are you calling from, are you attending this webinar from, and were you here at yesterday's webinar, just so I get a good idea. So Germany, yes. Portugal, yes. France, and someone's watched part 1. Thank you very much, because we do have this on recording, by the way. Yesterday's webinar is now on the FX Street website. Northern Ireland, Texas, Netherlands, London, New York, China. People from China are actually, I think it's about midnight there, so thank you very much for your dedication. UK, Mexico, Egypt, first time. Welcome to our attendee from Egypt, Armenia. And one person saying the internet is a beautiful thing. It is. And also my thanks to FX Street for building a very powerful site and full of forums such as this, and of course useful information that people can look at to try and decide what to do in these uncertain times. And welcome to all of you here who have attended yesterday's webinar. This should be a more comprehensive view if you've watched the webinar yesterday. And for maybe some of you who maybe this is the first time to see this webinar on Japanese yen, I will do a quick summary to refresh those who maybe were here yesterday, and for those who haven't been here yesterday, hopefully that'll give you just a good foundation catch-up as to what we were discussing. So welcome to all our dedicated audience from around the world, and also to new attendees. We hope to increase the interest in these MIG Bank webinars with FX Street. Now, yesterday we covered part one, which is basically market outlook. We looked at the latest Bank of Japan intervention and what were the key trigger levels to keep in mind. It's very important for me to give you the bottom line and give you something actionable that you can, use as soon as possible. Then I wanted to make the point about how the latest intervention, which is the third this year from the Ministry of Finance and Bank of Japan, how that not only affected the Japanese yen, but it also impacted many other key markets, especially the markets which are associated to high risk appetite. So markets such as Euro dollar, Aussie dollar, so Australian dollar, and the equity markets such as the S&P and so on. So we had major sell-offs in each of those markets. And then my last point that we covered yesterday was a section on what do long-term cycles tell us about dollar yen. So I'm going to quickly just go through that part. Keep in mind that once I quickly summarize that part, which FX Street have kindly put as a link within this forum, so you can watch it afterwards, we're going to look at part two and part three. Part two, external influences. The point that I made yesterday is there are so many influences that have impacted dollar yen this year. Of course, you had economic influences, you had technical influences, so just general demand and supply, investment, trading psychology, but we also had big shock influences such as the unfortunate earthquake in March, which followed up the previous earthquake that was seen in 1995 in Kobe, in Japan. And then, of course, multiple central bank interventions proving to be another external influence. So we're going to focus on part two, central bank interventions, event shocks, look at the various earthquakes and what that tends to mark in currency trends. And then focus on safe haven flows. A lot of people talk about the Japanese yen as a traditional investment during uncertain times, or when people want to increase their safe haven holdings. The Japanese yen is seen as attractive. So I want to ask the question: is there a wave of change? Is there going to be a decrease in safe haven flows into the Japanese yen, as we have seen with the Swiss franc and some other traditional markets such as gold as well? So will safe haven flows trigger a wave of change across Japanese yen, Swiss franc, and gold? And what will that mean for alternative safe havens out in the market? It is a relative perspective that we need to think about these days when everything seems to be uncertain and volatile. Part three is the last part. We're just going to look at I'm going to quickly take you through just a quick trading model that I use in each of my presentations. Just a step-by-step guide as to how to analyze the market. I call that pyramid analysis. And then I'm going to talk about just various other high probability strategies. I'm going to just make a key point about the options market and how that might be a great way to diversify risk and have a much better success in actually trading the Japanese yen at this moment in time when it is such a two-way market and quite volatile. And then lastly, I'm just going to end on other relative Japanese yen opportunities, so not just the US dollar against Japan, but other currencies as well. Now, apologies if I'm speaking a bit too quickly through this. I just want to make sure I go through this summary section quickly so that we can spend the rest of the time on part two and part three. So just a quick summary on part one. This is the disclaimer that I have to show you. No information published constitutes recommendation to buy or sell, and this is mainly informational and educational observations that I'm sharing with you. So I have to give you this disclaimer just for legal reasons here at the bank. You can read the rest at the end of the recording. Okay, so we're obviously here today following the Japanese yen intervention, which happened late Sunday hours of this week. 7 trillion yen was pumped into the market. for the third time, the Ministry of Finance intervened, and they said many times that Japanese will continue to intervene until satisfied. Now, this also triggered a big kind of unwinding on risk appetite market, as I mentioned on the onset. Key trigger levels to keep in mind, upside trigger levels. If this reversal in dollar yen were to actually confirm, we need to see moves above 80, and this is a big level that the Bank of Japan will be watching very closely, and of course many traders and investors. Keep in mind also previous levels where the Bank of Japan intervened and when the earthquake actually took place in March of this year, and those levels are 82 and 83.50. The one point I'll make here is, of course, I mentioned that one of the big trading techniques I use is the mark indicators, which highlights reversal signals, and you can see there at the bottom of the screen that it signaled 3 buy signals into the last intervention that we saw, and then that was a very kind of strong signal within this base pattern for an upside reversal on dollar yen. Now we can see general broad weakness of Japanese yen against many other markets, and that's what this chart here shows. And this is a trade-weighted representation of the Japanese yen against a basket of currencies. You can see this is going back as far as 2008. The general trend is up, so that's Japanese yen appreciation in value. But very recently, we can see there a breakdown reversal, downside reversal in the Japanese yen strength, pushing down, so weakness in the Japanese yen across other currencies, US dollar, euro, but also some of the other broad currencies. Now, I mentioned that there was this also helped trigger a major reversal on key markets such as the euro dollar and the Australian dollar and S&P, the kind of notoriously known as the high risk appetite markets. So here we can see a key reversal from a 2-year trend line, internal trend line on euro dollar, and this sharp reversal targets, in my opinion, 130 and even lower. On our model portfolio here at MIG Bank, we currently have a short position very early on that reversal, which we're holding for move down to 130. The Australian dollar also reversed very dramatically off that key horizontal level, back through the 200-moving average at 104.09, and is now moving back into parity levels, 1, and of course, after that, 0.94. And the last point I made was, of course, on the developed Western equity markets, S&P being one of the most important proxies. And here we have a major reversal in general Western equity markets, specifically S&P, from this major neckline resistance area from this distribution pattern, again, potentially signaling further sell-off in the risk market and in the Western equity market. Now, one of the key points I made about dollar yen here is that it's important to keep in mind on this overcrowded trade that we're seeing in the dollar yen, where people in the market, traders, investors, are looking to pick the bottom in the market. A lot of people are looking to identify the key reversal point for the upside in dollar yen, and we're seeing this in various sentiment measures. One of them, the number one sentiment measures I use is options contract data, and this white line here that we're looking at is showing you the number of call options versus put options. So call options being contracts to buy dollar yen, and put options contracts to sell dollar yen. And so you can see here the difference between the two is skewed at a multi-year high, favoring call options. So a lot of people in the market looking to buy dollar yen, and this is at a multi-year high. So it is a very overcrowded trade, and this is the overcrowded trade which the Bank of Japan is fighting. Remember, the Bank of Japan is trying to control the Japanese yen record appreciation because it's hurting its exporters. Japan's an export-led economy, but it's also fighting the market forces of investors and traders, which are pushing the market in the opposite direction and trying to find a reversal at the same time. There's conflicting trades going on there. People trading Japanese yen for the safe haven play, and also a lot of people, based on this options data I'm showing you, that are looking to buy dollar yen because they feel that there's going to be a major reversal taking place to the upside. US dollar outperformance over the Japanese yen. Now, the very last point I made in part one is long-term cycles, and this is my explanation of long-term cycles that I tend to show in my presentations. It's just basically a tidal wave, and if you can imagine yourself kind of being in front of that tidal wave, and during that time, you're scared by this big move in the market, and you need to be aware of how this long-term tidal wave can actually catch up with you in the end. Now, these cycles tend to be divided up into three separate cycles. The long-term cycle, you can describe as the tide in the sea, spans from 1 to several years. The long-term cycle, medium-term cycle, think of the waves in the sea, several weeks to months. And then ripples, the kind of very small, subtle movement in the sea, multi-day to 3 weeks timing. These are three different cycles you can keep in mind. Now I'm just going to show you where I think dollar yen is currently within this roadmap time cycle. Now I believe dollar yen is here at the very bottom, at the cusp of a major reversal to the upside, where we're likely to see a big move up, and this is basically where we left off yesterday in part one. Now, the reason why I believe that is based on this historical chart here, big picture chart of dollar yen since 1970, and this is showing you massive depreciation in US dollar versus the Japanese yen gaining in value. But if you actually look at it from a pattern perspective, pattern analysis called Elliott wave analysis, this is a major reversal pattern of a strong down cycle, and this is kind of a 5-wave down sequence which is ended and looking to push higher. If you look at a 5-year history of dollar yen, you can also see that it's been trading within this wedge pattern, which basically means that the volatility in the market has been decreasing with every price swing that has been moving up and down, and ultimately that will break out in a very strong way. And my expert opinion is that we will see an upside breakout. So this is likely to break out to the upside, but for the meantime, volatility is really decreasing, relatively speaking, based on this historical pattern, and we will see a massive move on dollar yen. Of course, the question is when and at which level we will see this. So in the end, I mean, what you need to think is that the market structure, the market forces, investors and traders psychology, is ultimately likely to, the probability is that it will break to the upside. And this will assist the Bank of Japan's interventions, but to some extent, the Bank of Japan's interventions is losing its effectiveness, its credibility in the last few months that we've seen. Okay, so that's part one. I've managed to cover it in a record time, and I hope that was a good kind of refresh to everyone here. Was that okay, basically, the part one that I covered? Can I just get a few okays from people? Is that okay? That part one, we covered latest Bank of Japan interventions, key trigger levels, a focus on the options market and how that tells us the market is overcrowded. A lot of people that are buying call options for an upside reversal in dollar yen. And then what do long-term cycles tell us about dollar yen? Okay. Yes, I agree. I hope to get to part three as well. So I'm going to quickly go through part two and spend most of the time on part three. Part two is external influences, central bank interventions. I'm going to go through like a stage-by-stage example of previous central bank interventions by the Bank of Japan on the dollar yen. We're going to look at event shocks, just one slide that shows what happened when we had the earthquake in 1995, the Kobe earthquake, what actually happened in the market, and then just a quick word on safe haven flows and how that wave of change may be taking place, moving out of markets, traditional markets such as Japanese yen, Swiss franc, and gold, and potentially into other safe haven alternative markets. Part three we'll cover once we finish that. Now, this is an illustrated history of Japanese yen intervention. This is a long-term chart of the dollar yen currency as far as 1993. The red histogram is showing you the Bank of Japan FX intervention. So the number of billions of yen that were invested on the interventions on the dollar yen. And the blue circles and squares are showing you those turning points in the market when the Bank of Japan intervened on the dollar yen. And you can see there are various points there. The squares, the big squares, are the areas that I'm going to focus on the next slides that follow. So I'm going to look at 2011, this year, the three interventions that took place, 2003, 1998, 1995. Notice that each of these interventions were at key turning points, structural turning points in the dollar yen market. And that is an important point here, because it is when the trend reverses that we see these turning points in the market that assist the Bank of Japan. Okay. Now, one of the things that should keep aware of are these 3 points here, and this is based upon my analysis of the last 10 years of Japanese yen intervention. Japanese yen intervention by the Bank of Japan or by multilateral intervention from other central banks tends to help develop major turning points. Virtually all Japanese yen interventions over the last 10 years exhibited what I call post-intervention retracements. So that basically means the market reacted, spiked in a very sharp way after the intervention, as you would expect after several billion yen is pumped into the market. But the market price then returns to pre-intervention levels, or they retrace to pre-intervention levels, what I call post-intervention retracement, or PIR. Now, in some cases, we see new highs and lows. And this was actually, we see new highs and lows before the market actually returns and reverses its trend. So this is an example here that I'm going to show you in the following slides. So here we're going to look at post-intervention new lows during the last 3 interventions that we've seen this year, what I call 3 strikes, if you can think of American baseball, where the Bank of Japan and the Ministry of Finance have intervened 3 times this year, 2011. Now, of course, it all started when we had the earthquake, and if I just pull it up on the screen, just 1 second. The earthquake happened here in March of this year, the unfortunate earthquake in Japan. And the day after, of course, we had that strong intervention by the Bank of Japan. It wasn't just the Bank of Japan, it was also the G7 nations, so it was a multilateral intervention on the market, and the market moved in a very big way. Then we had the retracement that I'm talking about, the post-intervention retracement, and which marked a post-intervention new low. You can see the PINL on the bottom of the chart there. Now, what is important to keep in mind is how long it took the market to make that new low, to return to post-intervention levels. And generally speaking, it took about 4 months or so for the market to then retrace back to post-intervention levels. So that's actually a good sign. But keep in mind, one of the big reasons why it may have taken the market so long to actually retrace back to post-intervention new lows was the fact that we had a massive earthquake in Japan. So that also would have really shaken the market structure and, of course, the psychology in the market. So that would have been a double whammy combined with the intervention. And keep in mind, it wasn't just the Bank of Japan intervening, it was the G7. So combination of a massive external shock from an earthquake and multilateral intervention, which is, of course, a lot stronger than when it's just one central bank. When it's several central banks, then you're talking about a big footprint in the market that will mark a big change. Now, there's a question here, why when the earthquake happened, the yen strengthened? Should it have been the other way around? The yen didn't strengthen. The yen capitulated and gained 400 pips in just literally, I think, a few minutes. I arrived into the office here at MIG Bank on that morning to see that the market had moved 400 pips in just a few minutes. It was the intervention that then, by the G7 and the Bank of Japan, which then created the reversal. So you see the hammer candlestick pattern and that spike intraday low, that was the yen gaining in strength. So thank you for that question. The yen did gain strength after the earthquake, moved 400 pips in just a few minutes, but it was the intervention that then helped the reversal take place to the upside. Now, we had the retracement, then we had the post-intervention new low. That took about 4 months, but it was the combination of the earthquake and the multilateral intervention by the G7 and Bank of Japan, which of course is a lot stronger than just one central bank. And then we had another intervention in August of this year, not so long ago, during the summer, where the Bank of Japan intervened. We had the big spike up. But keep in mind, this time around, when we had the retracement, it only took 1 week for the market to make a new post-intervention new low. And I mean it's interesting to look at the time frame here, to look at the time duration. And what this tells us is the credibility of the Bank of Japan's intervention is diminishing. The more the Bank of Japan is intervening at this current moment, the less credibility or the less impact it's making on the dollar-yen currency at the moment. Now, having said that, I believe that the market structure will eventually help the Bank of Japan and the Finance Ministry's agenda in depreciating the Japanese yen from overvalued levels. It won't just be their intervention, it'll be the market structure reversing from this long-term down cycle, moving much higher. So what I'm trying to say is that intervention, reactions to the intervention have been decreasing each time, and I'll show you that through the other slides, but it will be the market forces that will ultimately help the Bank of Japan depreciate the overvalued Japanese yen. And of course, just lastly, we had another post-intervention new low where the market made a post-World War II, yet another post-World War II new low at 75.35, where we had the latest Bank of Japan intervention. Now, someone's asking what would have to happen to change the structure of the market, and what does that change mean? When I say market structure changing, I'm mainly talking about the long-term cycles, and we would basically need to see confirmation of a reversal in the market cycle. And so a lot of clients are asking me, where's a good level to get involved into the market and so on. I mean, the key levels that I mentioned, 80, 82, and 83.50, these are the levels that we should be watching. And I would really recommend that everyone wait and see. Let the market tell you when it's going to reverse. Try not to anticipate, because dollar yen has proven to be the pain trade out of all the currencies out there. There is a reason why it's earned that notorious name, the pain currency, because a lot of people have got stopped out and potentially have had a hard time trading the currency. And when you have so much external influence, earthquakes, and also multiple interventions by the central bank, it's not as freely traded as some of the other currencies out there, and so it is that much more difficult. Having said that, I would wait for the market to tell you when it will reverse by watching key levels. The 80 level, which the Bank of Japan will be watching very closely. They'll be happy to see the rate move above that. 82 and 83.50. Okay, so I hope that answers your question. Okay, 2003. This was the last time when people talk about the intervention that took place this Sunday for about 7 billion yen. That matched the amount of money that was injected into the market in 2003 when they last intervened. And that intervention was roughly around here, December the 9th, 2003. And it took the market it retraced. You had a post-intervention new low. And then the market took about 2 weeks then. So again, intervention doesn't always hold the market back. 2 weeks before the market made a post-intervention new low. And then, of course, we had a major move on the upside. We did get a structural reversal in the end after that intervention. But again, I would say that it's down to the market structure in addition to the intervention. The last time before that was 1998, where dollar yen was at record highs, around the 147 level. So dollar yen has moved from quite some way from that extreme high. The intervention happened just at this point here, where you see this candlestick reversal pattern, and then the major sell-off, so the market pushed lower. And during that time, after we had the major sell-off, we did have then a further uptrend. US dollar outperformed the Japanese yen, so Japanese yen depreciating in value this time around. And that was a joint intervention by the Bank of Japan and the American Federal Reserve. Now, that took approximately 1 month and a half for the market to then ignore that joint intervention by the Bank of Japan, US Federal Reserve, and then make a post-intervention new high before the trend actually reversed back down again. Now, last but not least was the intervention that happened in 1995 after the earthquake in Kobe, so the earthquake that took place several years before the one that we saw very recently in Tohoku. And that happened during this time here. The earthquake actually helped a structural reversal take place in dollar yen, and then during that time we had the massive uptrend kind of build up, and it was during the uptrend and the major trend reversal that we saw the Bank of Japan intervene twice, during July 7th and August 2nd. So here I'm just trying to say that, I mean, if the Bank of Japan is kind of, it depends when they intervene, and if they're intervening after a trend reversal in the market, then of course that assists their mandate. And here you can see how intervention was successful back in 1995, because number one, you had the external shock of an earthquake in Kobe, which helped mark a major bottom, and that tends to be the case when you get these major shocks, external shocks. It might be war, it might be earthquakes, it might be natural shocks, or it might be political shocks in the system. That tends to mark major bottoms and highs in the market. But also when you finally get the confirmation of a trend reversal, if a central bank intervenes during that structural change, then of course that will help its mandate to depreciate or appreciate that currency. Now someone's asking is, I guess investors are holding the yen until they see a fall in Europe and the US dollar starts to appreciate. Yes, I mean that's also a good intermarket perspective. People are looking at other proxies to work out, relatively speaking, what might be the safest thing to hold on to. And of course, with the turmoil that we're seeing in Europe, specifically with what happened this week with the Greek referendum, and problems in the US, people are watching other markets, relatively speaking, to work out what to do with their yen holding as well. So this is in combination to everything that I'm talking to you about now. Okay, now I mentioned event shocks such as earthquakes, and this is just a quick slide showing you the Kobe earthquake and its effect on dollar yen back in 1995. And what we see here is, I mean, key point here is that event shocks equals market reversals. If you look back through history, again, if it's event shocks of a political or Mother Earth natural type of external shock, they tend to mark major bottoms and major highs in markets. Generally speaking, it's usually major bottoms. So if you think of earthquakes and tsunamis, that tends to mark major bottoms in markets, and also maybe political wars, that also tends to come at major cyclical bottoms in the market. So that tends to be a good reversal signal to the upside. And that's what we saw in 1995, but it didn't happen overnight. If you look at the blue rectangle, you'll see that it took dollar yen 3 months of recovery and accumulation before it reversed higher and then trigger a 29% recovery. There you see the green arrow pointing up with a 29% recovery. So keep in mind, this is a historical example of what did happen and potentially what could happen. It has been many months since the earthquake that we saw this year. Remember, it was in March. But just keep in mind, this is a historical example of what can happen, and it's good and healthy to make comparisons of this nature. Now, here I'm just quickly kind of showing you a picture of this big kind of shock happening in out in the volcano there, while you and me, everyone is sitting within this cave looking for safety. And this is basically what we're doing right now all around the world, in various different countries that you're all coming from. We're all hiding in this cave, trying to stay safe from this dynamic volcano that is erupting on a regular basis. Think of all the news headlines which have been coming out on a regular basis. Bearish, negative. Sometimes there's a positive headline, but to be honest, it's all relative. It's positive because things, relatively speaking, have become so bad in economic terms and uncertain in economic terms. So we are all hiding in this cave, seeking safety. When we think of safety, when you look at this picture, think of safe haven and safe haven flows. And where do we find safe haven investments? What would be the best safe haven investment? Now, keep in mind, traditionally, that has been Swiss franc, gold, and Japanese yen. Now, my argument here, in in just a few minutes, is that these three markets which I've mentioned are losing their safe haven focus. And one person just made as well a good point. U.S. treasuries, or just government treasuries generally, are also seen as a popular traditional safe haven play. So these four markets, Swiss franc, gold, Japanese yen, and government treasuries, specifically U.S. treasuries. Now, part of the reason why there's a wave of change in this safe haven flow, if we start with Swiss franc, is because, of course, the Swiss franc continued to make record highs again and again, similar to the situation that we're seeing with the Japanese yen. And of course, the Swiss National Bank intervened very recently in an unprecedented way, and basically said that they would use Euro-Swiss as a proxy and create a floor on that currency to make sure that people reduced the amount of safe haven flows they were injecting into the Swiss franc, because, again, the currency being so overvalued, this was impacting the exports in Switzerland, so the Swiss National Bank moved in quite aggressively. Now, what we have seen technically is a 31% reversal in the Swiss franc. So this is dollar Swiss franc that we're looking at. So US dollar appreciation against the Swiss franc. So keep in mind, this is very important. This is a decrease in safe haven flow in the Swiss franc. We've seen a similar situation with gold, which has seen roughly over 600% gain in value over the last few years, which is amazing, extraordinary. But again, it became an overcrowded trade when gold made record highs and almost reached that $2,000 glass ceiling, which everyone was looking at, that psychological ceiling. And very shortly thereafter, we saw a 20% capitulation in gold and other markets such as silver, other commodity markets. But just keep in mind the amount of people that long gold positions, gold bugs in the market, that were basically squeezed out of the market. My opinion is that if we see a confirmation below 1600 and 1530, that gold is likely to fall in a much larger decline from this mountainous rise, into an avalanche decline, potentially into $1,300 and a risk scenario for $1,000. Long term, I'm very bullish on gold. I believe that if we see a move to $1,300 or $1,000, this still presents a very unique buying opportunity for the long-term cycle in gold. I've already given a webinar on FX3 on gold, and I have an article on the website there that you can read. But just keep in mind this 20% capitulation in gold has told everyone that yet again another traditional safe haven has been knocked out of the market. Japanese yen, as I've shown to you before, this is showing you Japanese yen being squeezed within this wedge pattern, signaling that we're going to see a major upside reversal at some point in time. We don't know when. And so that again will signal further decreasing safe haven flows in the Japanese yen. Now, what does this mean? This means that people are seeking alternative safe haven investments. And during very uncertain times, what do people traditionally go for? They go for the reserve currency of the world, which still is the US dollar. So here we have the US dollar index, and the interesting thing is the US dollar index is in the opposite situation to every other market I've shown you, which is seen as an attractive safe haven play, because it's at extreme historic lows, oversold sentiment, momentum, and liquidity area. And now we're starting to see a major reversal in the short to medium term cycle in the US dollar. It already gained to 6-month highs, roughly 10% from its major lows. And so we're seeing a structural reversal in the US dollar, whether you agree with me or not. The US dollar was at 6-month highs, roughly 10% up. And in these markets, that's quite a big thing for the US dollar to be able to do that. And economically, the reason is safe haven flows, trying to find a home. There are fewer places to invest your money in safety because of the chart I just showed you on Swiss franc, gold, Japanese yen, and US treasuries, for example. And so that is creating a domino effect, which is shifting into the US dollar. My view is that the US dollar gains roughly about 30% in total on the dollar index over the next 6 months. So keep in mind the US dollar is likely to gain across many other currencies, and that's why we're seeing a major breakdown in euro dollar and various other key FX rates. Now, I'm going to quickly go through part 3 and hopefully kind of finish this comprehensive webinar in record time. And I hope that you've been able to follow this as best as possible. And I'll probably come back to your questions at the end just because of the time remaining. Now, part 3, we're just going to be focusing on high probability strategies. I'm going to quickly talk about this pyramid analysis. It's just one slide showing you a stage-by-stage explanation of how to analyze the market. Then we're just going to make a point about the options market and how that might be an alternative strategic way to get involved into dollar yen if you're currently maybe feeling that it's becoming very difficult to trade this painful currency. And then I'm just going to quickly focus on other relative Japanese yen opportunities, not just US dollar Japanese yen, but other relative currencies to the Japanese yen that might be more interesting. Now, this is the quick model that I always share with people in presentations and client meetings. I call it pyramid analysis, and it's 3 stages. The top of the pyramid is the most important stage, and that is trend analysis. And then you have key levels and indicators. Think of it as a macro approach where you start big and then you drill down into the micro, a top-down approach. You've got to look at the long-term cycles or the long-term trends, medium-term, short-term trends. Then look at your key levels. They might be support, resistance. They might be Fibonacci levels and various other highs and lows in the markets that might be relevant. And indicators, there are many indicators that we use. And I'll just make a point about the market indicators in the next slide, just to give you an idea of how you can incorporate these 3 stages: trend, key levels, indicators on the dollar yen. Now, on the dollar yen at the moment, the trend is, as we all know, down, as it is across many other markets. But we believe that trend is going to reverse to the upside, so Japanese yen depreciation against many other currencies. The key levels are, and one other point is that the market indicators signaled 3 buy signals, so telling you that trend may be reversing in the short to medium term time frame. The key levels are 80, 82, 83, 50, and the indicators is the market indicators which I just mentioned. So that's just an idea of how you can integrate that way of analysis. Now, I just want to make a few points about the options market and why this might be a very useful way to diversify your trading strategy on the dollar yen market. Option markets is basically an agreement to trade over time. It's a contract to buy or sell a market across a specific amount of time. Now, the key benefits of options, as I've probably said a few times, is a strategic alternative to your existing style of trading. So instead of just buying an up move or selling a down move, just an outright directional move, you can do more than that. You can actually use time as a proxy. So instead of taking a directional view, you can wait for that view to materialize and use the option market for that reason. Now, by doing that, you can actually manage your risk in a better way. Think about the number of times you may have been stopped out on dollar yen and various other Japanese yen currency proxies. So options, you're paying a premium. The moment you pay that premium, depending on which type of option contract you choose, that premium is paid, and then you just wait for the scenario that you've chosen to play out. In this respect, I'm going to talk to you about two strategies which might be very useful for the Japanese yen market. And then lastly, by waiting for this strategy to develop, you are actually maximizing a higher potential of returns in your trade portfolio. So these are the main benefits of options. Obviously, there are risks to using options just like any other investment vehicle, but if used in a specific way, the options market can be a good alternative to just outright traditional buy-sell trading techniques. Now, keep in mind that the option market might be useful because what we're waiting for is this big increase in volatility. This is the 5-year chart I've shown you already twice before of dollar yen being squeezed. Price swings are decreasing within this multi-year wedge pattern. Now, once this multi-year wedge pattern breaks, there will be a huge spike in volatility. Now, it might be very hard to trade this big increase in volatility just by basic buy and sell trading techniques. And I believe that the option market is a good alternative way to maybe complement your existing strategy by focusing on volatility. Now, this is just a quick theoretical example of one of the trade strategies I would recommend on the options market, something called the Straddle option, which basically means you are either buying or selling volatility. I'm not going to go through the theory of this. I'm just showing it there for you just in case you want to look it up. This particular picture is from Investopedia, so you can maybe check that, or maybe the FX Street website. I know they have material on the options market for FX. And a straddle option is basically buying or selling volatility. You're not interested in which way the market will move. So it's not a direction trade. It is just, you know that the market's going to break out and there's going to be an increase in volatility. So yes, it's also a good way to maybe hedge your bets as well. Now, in a straddle option, you're basically saying that this situation is happening at the moment. We have this multi-year wedge pattern where volatility is about to break out soon. You're not sure which direction it will break out from, but you're going to use a straddle option because you just know that volatility is going to increase over the next 1 to 3 months maybe. So you might buy a straddle option with a 3-month duration. That's an example of one of the very useful option contracts you could consider. Second is a call option. Ignore the title. It says straddle, but it should be call option. And a call option is basically if you believe that this long-term multi-year wedge pattern is going to break to the upside, which is my opinion, then in that case you would want to take an option to buy dollar yen upside. And that basically means you pay a specific premium. You see the word premium there, and that's the price that you pay. That's basically a price that you pay, and once you've paid that, that's your stop loss. Everything else is basically how you actually is the actual profit from the payoff. So you're maximizing the upside scenario if dollar yen were to break to the upside, and if it doesn't, then you lose your premium. That's the managed risk with a call option in the example of dollar yen. Someone's asking me, are the listing calls versus options available to retail traders? Yes, they are. You have to kind of liaise with various institutions that you're trading with. They will be available here at MIG Bank very soon. And this is in my strategies. I'm including mention of the options market just because I believe it's a very good way to diversify, manage risk, and also just have an alternative way to trade the market, especially when it's uncertain. Now, very last point I'm going to make. This is the last part of the presentation. I hope FX Street can just bear with me. Here I'm just going to focus on relative trade ideas on the Japanese yen. This is a chart showing you this rotation of relative performance. This is developed by a good friend of mine, someone I respect very dearly in the market, called Julius de Kempner, based in Holland. And he developed this scatter diagram, this proprietary scatter diagram that basically highlights key relative trading opportunities in a market. And this can be across many asset classes. In this example here, I'm using it against the Japanese yen to ask the question, what other currencies might be good trading opportunities against the Japanese yen, including the US dollar, but what other currencies might be better? Because let's face it, everyone in the market is looking at dollar yen, so perhaps there might be other currencies that would be offering better reward against the Japanese yen and maybe safer rewards against the Japanese yen. So this is a rotational chart. It rotates literally, and it's a quadrant. It's divided up into 4 areas, and you basically have leading markets that then rotate into weakening, then rotate into lagging, and then improving. I can do a presentation on this afterwards in another session, but just keep in mind there's a right clockwise rotation, leading, weakening, lagging, improving. And I'm going to show you what this proprietary rotational chart shows for the Japanese yen. Now what it basically shows is, here you see the lines there showing you the actual trends rotating in the market on a 1-month basis, historically. And you can see here the key areas, hopefully you can read here, is Japanese yen against Turkish lira, Japanese yen against the Brazilian real, Japanese yen against South African rand. So the 3 commodity-rich countries, Turkey, Brazil, South Africa, are very interesting opportunities against the Japanese yen. Now, keep in mind they are all leading. They're all showing Japanese yen at record highs. So Japanese yen gaining in value. But keep in mind that the fact that it's shifting into this the bottom quadrant is saying that Japanese yen is losing value against these currencies. So you have to switch your mind around. It's saying that Japanese yen is currently appreciating against these currencies, but that appreciation is decreasing. Does that make sense to everyone? So I've switched the currencies around. You're looking at Japanese yen versus South Africa, Brazil, Turkey, not the other way around. Does that make sense, everyone? Can I just get a quick okay, just to make sure that's okay? That makes sense? Hello? Everyone in the chat okay with that? Great. Okay. Now, I'm going to switch that around and show it to you the other way around. This is Turkish lira against the Japanese yen. So this is the way that you would trade it. And you can see here, definitely Japanese yen appreciation, which is what you saw on the rotational chart. So Japanese yen gaining record value against the currency. But what we see is a major reversal happening there. So what we're seeing is an interesting mean reversion trade where Turkish lira has lost a lot of performance against the Japanese yen, but it's now at bargain levels. So this is what maybe some traders and investors call bargain hunting, where you're looking for undervalued markets or undervalued currencies that might reverse in a strong way and then mean revert back to fair value or maybe other key levers. The 200-day moving average is one measure of a long-term fair value, and that is currently at 48.40 on Turkish lira. I'm also seeing Turkish lira upside against most markets, and so this is an interesting trade to keep in mind. Brazilian real also reversing. It needs to move back into this range and much higher. Now, interestingly, the Brazilian real had a major capitulation back in 2008. You see the red arrow there showing you that. And I believe, again, it's one of these bargain trades that might move back higher. South Africa rand, I'm just rushing through because of the time, also showing a good potential bargain trade. And finally, this wasn't on the chart, but I believe this is an interesting one, Australian dollar versus the Japanese yen. This has reversed very sharply below its 200 moving average. And once it breaks below this trend line, this neckline at around 75, it will signal further unwinding of global risk appetite. Now, I've covered all 3 parts, and I've just been told I only have 1 minute left, so I'm very happy that I've actually managed to finish in time. We've covered market outlook, external influences, and high probability strategies. I hope it's been interesting. Sorry for running this through very quickly. And my last thoughts with you is my proverb and mantra for many years: enlightenment through realized knowledge. I really, really hope that everyone here from around the world has found this presentation, part 2 of dollar yen, interesting. And as always, it is an honor and a pleasure to be sharing knowledge with each of you here. I've been holding these webinars now every month for almost a year at MIG Bank in Switzerland in association with FX Street. If you have any questions or if you're interested in any of the charts that I featured here, please feel free to email me on r.william@migbank.com and reach out to me on social media websites, Facebook, Twitter. My Twitter account is rwilliam77, and you can also catch me on LinkedIn or on forkstreet.net for the blog. And if you would like to receive our research for a 1-month free trial, again, just email me. It's something that I've asked our marketing team to offer for FX Street audience. Thank you very much. I hope you've enjoyed this. Dollar yen long-term structural change. I hope you enjoy your days. Happy trading, and I look forward to seeing you at the next webinar in December the 7th, where we'll be looking back at trends, key trends this year, and looking for opportunities in 2012. Make sure that you attend that webinar. That will be looking for trade opportunities in 2012, and it'll be my last webinar for the year. Thank you very much, FX Street. Thank you very much, everyone from around the world that has attended today. Bye-bye.